Good morning, everybody. Welcome to Focus Friday. Hopefully this is working. All right, great. It seemed like I was glitchy there for a split second. Happy Friday to everybody who is here. We are very, very excited to bring you Sean Wohland with Cherry Creek Mortgage to talk all things financing. Little bit of change over the last 60, 90 days. I think if you've been under a rock for the past 90 days, you might not understand what the heck has actually happened to the landscape of financing, but you're going to get caught up on it today. So before we get started, Sean, first and foremost, how was the party last night?
It was great, actually. Thank you so much for asking. We had about 70 people that came. Cinco de Mayo party, we had mariachi, we had games. I mean, it was a lot of fun. Lots and lots of margaritas too.
Incredible. I love it. And this is just, guys, if you've ever coached with me, I always talk about throwing events. Hey, do one a year, do two a year, do one quarterly. This is Sean's big one. So he does this, all bunch of industry leaders, real estate agents, financial planners, all the things, all potential resources. And again, if you know anything about me, every person is a conduit to 10 people I don't know. So Sean, way to lead by example. So guys, first, here we go, rocking and rolling. Sean Wohland, again, thank you so very, very much from Cherry Creek Mortgage. You guys got to follow this cat on social media because he is pretty darn funny. So Sean, before we get at the end of this, if you wouldn't mind putting that in the chat box where we can follow you on social.
Absolutely. Yep.
But guys, Sean's been in the business for 23 years. 23.
I know it looks like it's only been 5 or 6 based on my skin, but hey.
I don't understand how I have more gray hair than you in the line of work that you're also in. But Sean's been doing this for 23 years. Recently jumped over with Cherry Creek. He took his entire team and just went, boom, here we go. He is currently licensed to lend in 6 states. But guys, the natural, beautiful thing about this entire organization, just like his, is he's got reach in everywhere. So he's got partners who can handle everything, originators in 48 states. Guess what the 2 states that are missing? Georgia, no one wants to go there because it's way too damn hot, and New York. And I'll just keep my feelings to myself. So Sean, with that being said, sir, the floor is yours. Thank you again for being here.
Oh, it's my pleasure. I'm sure you guys are wondering what the heck is happening with interest rates. A lot of you are probably following it as well, just to try to keep a pulse to be able to answer questions that your buyers and sellers have. But it has been very, very volatile. And I want to kind of make that make sense for you guys right now. So first up, I wanted to just let you know a little bit about who I am. I'm married for 24 years. I've got 3 teenage kids, and it's crazy, but they are still loving me, which is fantastic, and I'm still loving them. So that's kind of what I do everything for. That's my why in life is my family. But so let's get right into kind of what's happening with the markets. It's interesting. So let's move back in time to pre-pandemic. We were at rates around 4%, right? So at that point, the federal government was buying mortgage. I wouldn't say federal. The feds were buying mortgage-backed securities at a low pace. So when they're buying mortgage-backed securities, what that's doing, that's really heating up the bond market and making it so rates come down. It's called quantitative easing. You probably heard that over the last 10 years. They kind of pulled the different levers to try to bring interest rates down. They've been doing that for a while, but when COVID hit, they went into overdrive. They put the pedal to the metal and they pushed that thing into the red on the RPMs, and they started buying mortgage-backed securities at the tune of $60 billion a month. So that drove interest rates to a point that they've never seen. Nobody's seen rates in the 2s before. It really is not natural. It's completely unnatural. But what that created was a very natural response, a human response of what? Setting expectations, right? So now everyone's got the expectations of 2s and 3s. So rates in 4s, 5s, and 6s is like the craziest, worst thing on the planet. So the first thing we have to do is set proper expectations. People need to understand that was the Black Friday sale. You know, it's over. That was a once in a lifetime opportunity. If you were able to cash in at the time and purchase a home or refinance with a home, good for you, because that's not normal. It's not natural. It's just not the way markets work. Nobody can make money lending at 2%. Nobody can. That's less than inflation. It's much less than inflation right now. And that's a good segue. So inflation is the enemy of long-term interest rates. If you invest in something at 2% and the inflation's at 8%, you're making a net loss of 6%. So mortgage bonds are a 30-year commitment to a 30-year bond. You get a return based on the bond that you purchase. So mortgage rates are not tied to the Fed funds rate. I want to make sure you guys know that. The Fed funds rate is the rate at which banks borrow money overnight for 24 hours. It is not a long-term interest rate. So when people say the Feds are raising the rates, that does not mean they're raising mortgage rates. They are raising the rate at which banks borrow money over a 24-hour period, a very, very short term. So in fact, when the Feds raised it on 50 basis points on, was it Wednesday, what happened was the bond market actually improved 60 basis points. So what we want in the mortgage world is we want inflation to go away. Because if inflation goes away, mortgage rates will come back down. So what you really want to pay attention to are the inflation numbers. We are going to see continuing inflation for the next couple months. We're going to see actually inflation come down and then come back up again in September and then drop off like a cliff, I think, after that. The way inflation works and the numbers that they tell you is based on a 12-month average. So 12 months ago, if inflation was at 0.4, but now this month it's at 1, we're now going to replace that 0.4 with a 1, and now it's going to spike. If inflation is at 0.9 and we're replacing it with a 0.6, then it's going to come down. So we have a couple months in front of us in through the early summer months where the inflation was very low 12 months ago, and we're going to replacing that with a moderate number, which is lower than what it's been, but it's still higher than what that number is we're replacing. So make a long story short, inflation will correct itself over time, but we're going to see it get a little bit better, then get a little worse, and then after September, we're going to see it get a little bit better then. So inflation is our enemy. It's our enemy, or whatever we want to call it, but it's the bad guy when it's in the mortgage industry.
It's the Darth Vader of finance.
Yeah. Now, the one thing that you want to really pay attention to, and this is the scary part, this is where we don't really understand. These mortgage-backed securities that the government has been buying, or the Feds have been buying for the last 10 years, but at an extreme rate this last couple, they're now selling those off. So if you are going to say that the rates are going to be getting better by buying them, what does selling them off do? And that's the fear. That's why we've seen this big spike. Is early in the year, the Feds announced that they're going to be rapidly selling off their mortgage-backed securities. What the term they're using is their balance sheet. They're going to be selling off their balance sheet. So just to let you know what that balance sheet looks like, it's $9 trillion in treasuries and mortgage-backed securities. So they're going to be selling off. They're going to start with about $17.5 billion in a month in mortgage-backed securities and about $30 billion in treasuries. Through the end of the year, that's only going to be about $500 billion. It sounds like a lot. $500 billion in treasuries and mortgage-backed securities that they're selling. That is only, I mean, think about that. That's half of 1 trillion.
Right.
There's still 8.5 trillion to go. So here's what you're going to see. You're going to see the Feds, and the Feds have no idea what's going on right now. I mean, they're just trying to figure out how to offset inflation, but they acted way too late. So make a long story short, there's still a long ways to go. They may end up buying mortgage-backed securities again to tame the mortgage industry and pull the rates back down. But I think what's going to happen is we will see a recessionary period coming. It is on its way. We've already had 1 quarter of negative GDP. 2 quarters of negative GDP in a row is a sign of a recession. So we're on the way. That's not bad for real estate. In fact, it's actually good for real estate. People move around during recessions. A lot of sales happen during recessions, and mortgage rates come down with recessions. So it is a total shift in what's happening in the market right now. You guys have probably seen it. Jeff and I talked a little bit about the volume that you guys have seen and maybe the uptick that we've seen in the number of listings that are hit. I know this month alone is up like 44% in listings. So what we want to really focus on is expectations on the mortgage side. It is, if they were pre-qualified 6 months ago and they're still looking, it's it's a blow in the face. It's like a left hook from Mike Tyson, right? Here you're looking at a payment of maybe $2,500 on a second home, and now that is like $3,600 for the same exact property, and the prices have gone up. So we have to set expectations. I've got a few tools that are very, 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 very effective in doing this. I want to talk about them as well, but I'm going to go over just a list. There's a bid over ask report. The bid over ask report basically says if I go $50,000 over ask, how long will it take me to recoup this based on normalized appreciation? Not this crazy appreciation we've seen, but normalized, like 4 to 5%. Maybe the same as inflation. What does that look like? How long will it take to recoup this over ask? Because a lot of people say, you know what, I'm not going to pay over ask. And then they lose out on houses. And how many houses have they lost out on in the last 6 months to a year because of that? So this is a great way to have in your listing presentation or sellers or buyer presentation called the bid over ask. There's also the cost of waiting. The cost of waiting is, okay, let's just say rates are going to come back down. Everyone says rates are going to come back down eventually. I'm just going to wait for that to happen. Well, let's look at that. So I have a report that says, okay, right now, let's just say we're at 5 3/4. If you buy now versus waiting next year, and next year we're at 5 1/4, and maybe waiting to 2 years, we're now at 4 again. What does that look like on paper if we waited and normal appreciation happened based on if you bought now versus waited? It's very, very interesting. The numbers do not lie. It takes in amortization, how much you've paid already. And as far as when you buy now, you're making payments to yourself, takes in that number plus appreciation. And even with the lower rates, you're way better off buying now than waiting. It's a great, great tool to have in your presentations as well. Also, you're going to see, excuse me, you're going to see seller buy. Yeah.
Sean, real quick, we have 2 questions in the chat if I can jump in. So one of the questions was coming from Jimmy, who's our managing director in Grand Junction, very sharp lad, if you will. He asked the question, he goes, do you think the lack of supply in real estate is going to ease or even prevent a recession, like a true 07, 8, 9 type of a recession? And then last question would be qualify normal appreciation, please.
Okay, so normal appreciation usually mirrors whatever normal inflation is. That's typical. So in a normalized market between 3 to 5%, I would say would be a normalized appreciation. 3 to 5% per year, not 3 to 5% per month. Like
yeah, right.
It's just incredible. So I have a theory on that. If you guys want to see my theory, I have some good videos on my social media. But in fact, in terms of recession, if you took every recession that we've had, except for what we call the Great Recession of 08, I'm not going to call that a Great Recession. That was a mortgage crisis.
Yep.
That was a stupidity 101 crisis. That was, we're lending money to people that don't have the money crisis, right? And then packaging these up and selling it as AAA bonds to different countries. I mean, that was different, okay? Every recession that we've seen the amount of sales in the markets and appreciation actually go upwards a little bit. So if you study every single recession by home sales and values, except for the one in 2008, you will see positivity in the real estate market. So we really have to look at what happened in 2008, 9, and 10, but as a grain of salt when we're talking recessions, because that was a financial crisis, not a recession. It was a financial crisis that led to a recession.
So, hey, Sean, I think it was maybe 2 or 3 days ago, you posted a video saying that 4 out of 10 homes are owned free and clear today. Do you know what that number was? Probably closer to 6, 7, 8, or 2006, 7, and 8, like comparing the two?
It was, believe it or not, it was about the same.
Really? Okay.
It's always ranged between about 30 to 50% as far as how many homes are free and clear in the United States. The problem with back then in 2008, 9, and 10 is, hold on, my phone's going crazy, is that every Tom, Dick, and Harry, I mean, you go to Home Depot and you're in the light bulb department and you're talking to the guy and you said you talk to him that you're in real estate, and the guy at Home Depot bought 10 houses. Yeah. You're like, that's yeah. That's how ludicrous it was back then. It was like, what do you mean you bought 10 houses? Yeah, I bought 10. I called them all primary residences, 0 down, and it was great. And it's just, that's the problem that we had back then. I mean, if you saw the guidelines we have now, it's everything. Everyone has money. I mean, do you guys even understand where this money's coming from? It's everywhere, right? It's because our economy has been on fire, going at 9,000 RPMs for the last 4 or 5 years.
Yeah.
People have a lot of money. So there's a lot of money in real estate. People are not just going to walk away because they've got a lot of skin in the game. It's a much different world right now. But what we're going to see as we slow down is a tool that's going to be used, and you guys need to get well versed on this. It's the seller buy downs. So if you have a buyer that is just mad at interest rates and you're seeing a softening in the market, you can go into a listing, and let's just say it's $1.2 million listing and it's been on the market 50 days. You can go up to that person and say, you know what, my buyer really is not interested in buying right now because, and don't tell them this, but they're not interested in buying right now because rates are too high. But how about we do this? I will give you 1.15. I'll knock 50,000 off the price. But I want you to give that to us in the form of a seller buy down. I want you to give us $50,000 to buy down the rate so that my buyer can have a rate at 4% right now. Mm-hmm. So we're going to go in, maybe full price, but then ask for that $50,000 to buy the rate down. Get our buyers in at a rate at 4% so they're happy, and continue to work your buyers, because that right now, guys, buyers are fatigued. They're frustrated. They don't like what's going on in the markets. But if you can go to every single one of those buyers that is now mad because of higher rates are, and present them a solution to the problem by going into a market that has maybe some softness, and you can go in and go under, buy the rate down, everyone's happy. Guys, it's going to work. I promise you that. It's going to be a huge tool for the future.
Hey, Sean, is there a limit or a cap on that ability to buy down the rate? Because normally there's a percent cap that you get maxed out on as just for seller credits, yes. But on a buy down, is there a cap on that?
It's the same cap. It's either 3 or 6% depending on the loan type.
Okay.
Yeah, some jumbo loans max it out at 3, some go up to 6. That's where you have to work with your lender just to make sure you're asking for the right things.
Cool.
But these reports that I have, guys, are really, really helpful.
So how do we get our mitts on those?
Just shoot me a quick text, email. Right.
Awesome.
Say, here's my buyer situation, or here's the zip code I want information on. Give me 2 scenarios based on $1 million, $1.5 million, and a $2 million listing with 25% down. And then I'll get it over to you. I'll put my email in here. So
yes, please. Thank you.
And then WohlandMortgageTeam.com. I'll send you all my Instagram and all that kind of stuff as well.
Yes, thank you.
And then one thing I want to talk to you guys about too, the second home market, you're going to see slow down tremendously, because normal people right now, when I say normal people that need a loan to get out to buy a second home, they're being priced out because Fannie Mae created that new rule back in April 1st. It came into play where they are going to no longer want more than 5% of the second homes or investment properties on their balance sheet. So what they're doing is they're pricing them out. I priced out follow me on this. You used to be able to do a 10% down second home, and the rate was in the 3s. So I had somebody pre-qualified last December, 10% down second home. They've been searching, and the rate was in the 3s. Now that 10% rate is 6 3/8 with 3 points. And it doesn't pass Mavent, which is our high cost calculator. So now it's not even a possible loan. So they're forced into doing 20-25% down to make it even a loan that we can do to get past the high cost rules that we have in the mortgage industry. So you're going to see the second market kind of pause a little bit to those people that have mortgages because of this. Maybe the seller buy down is going to be something that you can really utilize in this, but it is incredible looking at these rates for second home and investment properties right now. So you're going to see a lot of cash buyers in that market. It is going to soften a little bit because of it. You probably have already seen it because you have a lot of offices in areas that have second homes. But expectations are everything, guys. We have to set new expectations with buyers and with sellers. So I'll open it up to any questions you might have. I mean, I've seen it all. I try to keep my pulse on everything that's happening out there. And again, I just want to be a resource for you guys to help you, because it is tough out there. We're all doing about 5 to 10 times the amount of work for the same amount of transactions. So just don't hit the bottle to solve it.
That's never a good idea.
No.
So Sean, I got one. How do we better explain this high level, like in layman's terms, like how should we be preparing our buyers or even our sellers? Because our sellers have to understand from a pricing standpoint, because they want the sun, the moon, and the stars when they price something. But the truth of the matter is, every time we get a little higher, we're weeding out a very, very large population of potential buyers. So how can we better, like, just one, two, three liners, just really, really wrap this whole thing up for our buyers and sellers so that we still appear to be the experts in the market?
Got it. So once, and I call it the Great Migration. Once the Great Migration is over, I mean, if you look at it, I have a little analogy where it's like, picture an anthill, and every ant had its own little covey and its own little place. And COVID kicked the anthill, and all the ants went everywhere. And now they're rebuilding their homes. They're going different places. That's kind of what happened in the United States, right? So once that is done, we're going to be in a more normal market. We're kind of getting there. Because of COVID, we can work from anywhere now. So the levels of homes, the values of homes is like equalizing across the country. It's kind of bizarre how you're seeing that. But I would say in a nutshell, once inflation is under control, the market will be back to normal. Give it 6 months and once inflation is under control, we'll go back to a normal market. Until then, it's going to be a little chaotic, but just know that I'll be here to support you. I mean, that's really what we have to say. But inflation is the #1 enemy. And that's why the stock market doesn't know what to do. That's why we've seen 1,000 points up, 1,000 points down. This morning it opened up down tremendous amount. And that's it's just, nobody knows what is going to happen until inflation is under control. That's why the Feds are taking such a huge stance on hitting it by 50 basis points, and now 50 basis points in June, and it's going to be 300 basis points probably before they end. So the only way to slow down a race car that is at 9,000 RPMs is to push the brakes and go down to 3,000 RPM so the engine doesn't explode. That's basically our economy in a nutshell. Once we're slowed down, it'll get back to normal. Those buyers will come back off of the fence. But until then, we just have to know we've got tools, guys. We've got the seller buy downs. We have bid over ask. We've got the cost of waiting. Those are the tools you need to really be presenting to them. That wasn't 3 sentences, but you can take the data from that and kind of extrapolate with what you guys want to in your own little personality. But
yeah, I think
as soon as inflation's controlled, we'll be back to normal.
That cost of waiting is always eye-opening, because it's one thing if I'm just telling you and talking, you're nuts if you don't do it now. But if I just show you 2 pieces of paper and be like, you tell me what's a better idea.
Yeah, and I can show you what it looks like. If
I think the group would love that.
Okay, let me share my screen real fast. And then let's see here. Here it is right here. All right, can you see this?
Yes.
All right, I'm going to zoom in. So what I did is so this is out of Denver. I took a current purchase price, $875. I mean, I did this real quick for you guys just to kind of see. I didn't put any down payment or anything. It's just the numbers. So forgive me on that. But this is if you waited 6 months, a year, 2 years, or 3 years, just based on the loan amount. Loss in appreciation, if you waited 6 months.
Wow.
You would have lost 29,000 appreciation. Now this is based on like a 4% appreciation. Waiting a year, you've lost 58,000 in appreciation. Waiting 2 years, it's 96,000. And then this number below here is the amortization loss. Remember, when you get a mortgage up front, you're starting to pay yourself like almost a third of the mortgage payment is paying yourself in amortizations. So that's money you're making. So those two combined, the cost of waiting after 6 months is almost $35,000. So this little graph right here shows you what the cost of waiting is over time. And then there's another one that I have, which is the bid over ask. Here's one. If you bid over ask, if you go 50,000 over asking, how long is it going to take you based on normal appreciation? That's 4.7 appreciation. It's going to take you 8 months to break even, and over 5 years, you have gained 305,000 in appreciation.
Wow.
So there's a lot of, I mean, these tools are here for you. And again, I can make these in a few seconds. I mean, they're
those are awesome. Hey, Sean, I know your focus is residential, but you're around some other smart individuals within your company. What are you seeing from a commercial standpoint? What's happening there?
Commercial's kind of a mixed bag right now. I see it like really, really booming in the people I have in the industry that are more of like a warehouse for shipping and like that kind of thing. And then retail space is like a question mark. Like, are people going to work from home? I mean, people are still making money. The markets are still strong. I think once the recession hits and more layoffs happen and the bottom dollars start to shrink a little, I think you're going to see the commercial get a little softer as well. Because, I mean, if people aren't going to go to the office and they're holding a $10,000 a month lease, and now they're cutting staff, they're going to second guess the bigger space. So you may see some consolidation, but guess what? Consolidation just means new contracts at different spaces, right? Yeah. So if you're in the leasing world, it's just going to be a lot of shifting. That's what's kind of magic about recessions. It's a shift. Like, there's still transactions being made, and people always adapt. So I don't have my pulse as strongly on the commercial side as I do on the residential. That's just kind of what I've seen and heard from those people I do know that are in that side.
Yeah, that's wonderful. Thank you. Let's see here. So there was one other question, and I think even my pea brain might be able to answer this, but it says, how do we deal with a $400,000 loan regarding a seller buy down? So it's just going to be anywhere from that 3 to 6% depending on the loan type.
That's exactly right. Yeah. A seller buy down works for every single price range, every single loan type, at every single value. I mean, really, it works for everything. So it's just a matter of percentage. 3% on 400,000 isn't as much of a haircut as it is on a $1 million or $2 million purchase. But everything's based on ratios, so it still works the same.
Cool.
Yeah. And I've got some really good stuff online on even how rates work. A lot of people don't even know that you can literally get any rate at any time. And when you look online, when you see rates at 3.75, like, how are they advertising that? It's because they're buying the rate way down.
Sure.
So I can advertise any rate at any time. If I wanted to advertise 3%, I totally could. Yeah. But what you have to put in the asterisk is what the APR is, all the fees and all the garbage, right? Yeah. But a lot of people don't see that. They just jump on it and then go.
So, hey, Sean, we had one, and I don't know how you haven't brought this up, but pros and cons of the 40-year mortgage. All we hear about is 15 and 30s. Talk to us about a 40.
So the 40-year is very interesting. I actually like the interest-only option better. You have more savings on that. But the 40-year is genius if you're the mortgage company or the bank that holds it, because you're making an astronomically amount of interest more. It's unbelievable. But it is a way to lower the overall debt to income ratio when you're getting into a mortgage. If somebody, it's not the best instrument. If you follow Dave Ramsey, he wants you to do the 15-year. So if you told him you want to do a 40-year, he'll probably blow his mind. But it is a great way of getting a little bit more affordability into the marketplace. And you're going to see, I mean, if you look at Japan's market, they have a 99-year mortgage amortization. I mean, these things are being like passed on to
generational.
Yeah. So how do you offset higher prices? You figure out different mortgages to make you get there. So who knows what the future holds for longer term mortgages, but it is it is a big talking point right now.
Here's an interesting question. I don't know if you know the answer because this one's a little dicey. Who's going to purchase the rest of that $8.5 trillion worth of mortgage backs?
So believe it or not, we're only buying about 30% of what is out there in the purchase market. The Feds are. So if that's 30%, that means 70% is other countries, other institutions. I mean, if you look you can go buy bonds right now if you wanted to buy them. Individual investors buy them. It's a guaranteed return. You can buy municipal bonds, you can buy Fed bonds, you can buy it all. So it's a good question. Who is going to buy them? Okay. That is, if you look at the calendar of events, you can look to see when those bond auctions are happening. And every bond auction is posted the results online and they grade them between A, B, and C. So based on the day, I can look on the Fed calendar or on the economic calendar and say, okay, we have We have a 10-year bond that's going to be auctioned this Wednesday. I'm going to watch that carefully, because if it's a really strong auction, then we might get rates might get better that day. If it's a poor auction, then rated as a C-, I'm like, oh, great, rates are going to take a beating. So I lock in real fast. So those are the types of things we look at. But yeah, that's a good question. There's a lot of different people that buy bonds.
What, Sean, what in regards to building, right? So construction loans, what's the impact there?
Yeah, that's a tough one, right? I mean, you go into a new build and you're pre-qualified at 3.25%, and you wait a year and now you're at 6%. That's the biggest challenge I've seen with that. But it's an unknown. People right now would rather buy a home that's existing than a new build, because they don't know where rates will be. Because they're getting punched in the face a little bit on that. Construction loans are usually based on prime during the initial construction phase. If you're doing a standard one-time close, you have the construction loan, you're working with a private builder. Those are based on prime, which is the prime, the Fed funds rate plus a margin. And then that is going to be increasing significantly over the next 6 to 8 months. So construction costs during the process are going to be a little bit more expensive for the borrower, because of the interest that they're paying on that. We all know materials are more expensive for builders right now because of the whole supply chain issue. So I think building is going to maybe slow down a little bit, which is fuel to the fire. Because I don't know if you've ever seen the graphs, but over every decade since the 50s, the United States has built 20 million homes a decade. This last decade, from 2010 to 2020, only 4.5 million. So we are down that decade. We are short 16 million homes so being built. So we'll see what happens with builders. I hope that the supply chain issue gets really fixed, because that's going to add fuel to the inflation fire as well. Those people, if you guys have people that are buying new homes right now that are under contract, the rates were in the 3s when they went under contract, and now they're close to 6. Have them explore an adjustable rate mortgage that may be fixed for 5 or 7 years, because they'll knock off about 1% on their rate. I honestly believe a year and a half from now, we will see a time to refinance. It's just inevitable during a recession. Once the inflation is controlled, hopefully it will be, and we won't be in the Carter days. But that's another conversation. But I honestly believe in about a year and a half, we'll see a little bit better rates than we are right now. Right now, it's just out of control. If you looked at it, I mean, every day I wake up and it's like a gut punch when I look at the bond market. So,
not to get political here, but I'll get political. In the event of the election results, Republicans-led Congress, is this a moot point? Is this, hey, it's just business as usual? Is it going to be a little less spiky?
Well, I won't get political. I'll just look at trends.
There we go.
But the trends are typically that the Republicans are a more conservative party. So as far as spending goes, typically, unless it's an emergency scenario like COVID or something like that, where you have to spend yourself out of a problem, typically there is, and I say typically, but it's a little bit more conservative. But I mean, our government spending has been out of control for decades now. So
that hasn't changed.
No, I mean, it really, both parties, maybe one's more conservative than the other. I mean, if you go to the mall and you blow $30,000 on shoes and somebody else blow $40,000, who's the most conservative? You're both out of control, right?
Yeah.
So who knows? I do know that everyone right now is taking a very hard look at this, because it's a big problem globally.
Yeah.
The inflation problem. So I think everyone's going to be on the same page on it. But when you print money like we have for so long, it's hard to overcome. It's hard to revert back from that.
Sure, absolutely.
Without damage happening.
So you're 23 years. What would you say is the average 30-year fixed rate?
6.
And the only reason I asked that is because I read watched a podcast a handful of months ago, and they asked the question. They said, over the last 50 years, what's the average appreciation we've seen in residential? And the answer was 5.4% over 50 years. That was the average.
Yeah.
So
Yeah. I would say that interest rates should be they should be in the sixes.
okay. That's healthy.
That's a healthy rate. I mean, that's a healthy economy, rates in the sixes. It's really interesting. People say, well, in the 50s, rates were at, home prices were at $50,000 and rates were at 7% or 8%. So why are you afraid of that? I mean, well, because our home prices are up 1,000% from there.
Right.
I mean, you can't just look at the interest rate. You have to look at everything, right?
Yep.
So, but yeah, I would say a good healthy rate, an average rate was probably in the 6.5. In fact, I think I have a graph I could show you. I don't know if I have it.
I mean, you're my mortgage nerd, Sean. Come on.
Yeah, it's the average rates over the last 50 years. Let's see if I can find it. Google it real fast. This might take longer than I thought.
No, that's totally fine. I didn't mean to put you on the spot like that.
No, you're here. I'll share it right now for you. Hold on one second. Share screen. All right. So where am I? Here we are. Hit share. All right. So this is the fixed rate in the United States. So this is when inflation was at its all-time peak, right? So let's just eliminate this right here, this spike. So if you take the average, I mean, it's kind of right in here. Yeah. And this is in the sevens. So this is 8. And then if you look at just the last since 1990s, I mean, this is 7.93, 6.59, 6s and 7s. And then we have, it just kept coming. This is when quantitative easing started. So back here under the Obama administration is when the quantitative easing started, when they started buying the mortgage-backed securities. It's all happening right here. So see that dip, boom, right here. Yep. And then there's some upticks. I remember that day like it was yesterday. That was not a good day for mortgage rates. But we saw this incredible refi boom. I don't know if you guys remember that refi program that allowed people to refinance when they're upside down. There was a huge push by throwing money at the bond market, quantitative easing to lower interest rates to help the housing industry. What we created is a new expectation of what rates should be at by the government intervening to make it a little bit more easy and cheap for people to buy and refinance their homes. So we had HARP, the Home Affordable Refinance Program. And then we had a little spike up here, and then this was COVID. Yeah. So a really good chart to say, guys, what is average? Like, show this to your buyers, show this to your sellers. Like, what really is average since the 90s, right? Yeah. Setting expectations is the number one thing that we have to all focus on.
Definitely. That's great. Thank you so much, Sean. I think you and we could do this for another hour and a half, but
yeah, I know it's really boring to a lot of people, and I apologize, guys.
It is so impactful, though. I mean, this is we as an organization have constantly been using the phrase "control the narrative," and any and all information. In fact, in the Bozeman office meeting just this past week, I was doing this long-handed. I was doing it on the whiteboard and doing like, hey, here's the difference in your payment, and do you think you'll get X amount in appreciation? So thank you for validating what we were preaching the other day. So I appreciate that.
Yeah, you're very welcome. I had a couple of questions in here. What is the ratio loan to value on residential properties? I think this is maybe what the average. With the average on purchasing?
Yeah, I think
I would say the average loan to value that I'm seeing right now on purchases is 20 to 30% down.
Okay.
First time home buyers right now are sitting the bench. I mean, they have no money to go over ask. Mm-hmm. Rates are they're squeezing them. They're in a predicament. They're in a predicament. A lot of people are doing these predictions that the buying homes and becoming a homeowner is going to become the American dream again. It's been the American expectation for the last 20 years.
Yep.
It's going to be turning into the American dream once again. Those people that have money will continue to buy up all the properties and pay cash for them and rent them out and create an even bigger problem of having less homes on the market that are churning between normal households. So inventory is going to continue to be a problem, especially like BlackRock and all these other more major companies buying up and renting these properties. I mean, imagine this. Imagine you get all the cash in the world and you can buy an investment that goes up 5% a year in value, plus it gives you a dividend of like 10% a year. That's real estate to an investor. So why do you think they're buying them up? It's a great investment. It's going to give you a dividend forever and ever, and it goes up. I mean, I'd buy that stock all day long.
Yeah.
And that's why REITs and everything have done so well in the last 10 years. But yeah, I mean, it's an interesting market.
Well, we appreciate your time. And before I forget, could you send me just those 2 snapshots of the bid over ask and the cost of waiting, and just so they have an idea of what that looks like and they can kind of just process that, if that's okay?
Absolutely.
Awesome.
Yeah, I will absolutely do that. And then also in that email, I'll send you all my handles for my social media. So you guys.
Yes.
Yes.
Awesome.
I'm kind of a dork, but I like to have fun. I like to be serious and have fun at the same time. I'm a kind of an enigma wrapped in a mystery when it comes to that kind of stuff. But,
well, guys, honestly, I hope you guys enjoyed this thoroughly as much as I did. Sean, thank you so much for your time. That was
anytime. And I actually have I have a live Monday morning update that I do every morning via Zoom. So every morning at 9 a.m. I go online, I show what's happening. I go over quick trends. It's no more than 15 to 20 minutes. And you guys are welcome to join me on that as well.
Oh yeah. If you wouldn't mind putting that link in there as well, that'd be great.
Yep.
Thank you, Sean. Appreciate you so much. Thanks for being a friend of the family, and we'll see you next time.
You got it. Have a great one.
Thanks, guys.